I'm ready, Mark.
Well, good
I am
afternoon.
reading Len's thing also,
Okay.
and I'm not sure that everybody sees the same thing that on their screen that Len is seeing on his. I am not seeing what Len says he's seeing on his screen.
It might have been an old
So,
note too. All right,
yeah.
let's get underway. Welcome everybody to the January 10th, 2023 bull session. We are here just 5 days after our delayed session last Thursday, but it's good to be back, and it's really kind of a neat time of year as we kind of crank through a little bit of a look back towards 2022 and then turn around and look the other direction, which is the right direction to be looking. It's also kind of our annual Friends Don't Let Friends Be Average Investors session. I don't know about you, Ken, but that's one of my favorite themes. Welcome, everybody. This is Mark Robertson. I'm joined here by my dear investing colleague, Ken Kavula. Good afternoon, sir.
Good afternoon. Hi, folks. We're so glad you're with us today. We're going to talk about some interesting things in the next 40 or 50 minutes here. So I hope you have a nice, comfortable chair and maybe something to munch on or something to sip on. And don't be afraid to engage us with some questions or some comments. We do allow folks to raise their hand, and right now, nobody's hand is up, so you can look at that icon that talks about raising your hand and say to yourself, right now, that's the way it looks when my hand is down. And then if you want to raise your hand, all you have to do is click it. I'll get a message, and we'll try to unmute you just as soon as we possibly can and let you actually talk to us. If that's too intimidating, then of course you can talk to us in text, write us a question, make a comment, and I'll try to interweave the answers to those questions as well as the comments into whatever it is we're talking about.
All right, so it is kind of our annual tribute to the Mortimer brothers and their $1 bet with over the exploits and adventures of Eddie Murphy in the moving trading places. And Ken and I are both willing to bet our dollar on the side of regular long-term investors working together year in and year out. And that's kind of the way it works. And it's fascinating to watch all that is done. Ken is a member of 4 investment clubs, I believe all of whom are actually beating the market.
Well, 3 out of the 4 are, Mark.
3 out of 4.
One of them's having a little bit of issue right now.
So one of them has dipped down just a tiny bit, probably like Tin Cup is misbehaved here over the last year or so. So yeah, it can happen from time to time. We expect that. We're not surprised when it happens. And yes, on the right, that is our tribute to Buc-ee's.
I did get an email from a South Carolina volunteer that was traveling up in North Carolina recently, and he said because we had said so many nice things about Buc-ee's that she was going to stop and see if it really was as great as we said it was. And she said she came away thinking it was even better than we had talked about, Mark. So,
well, Ken, you're holding a brisket sandwich there, and
yes, I am.
All right,
and it was darn good. It was darn good.
It's time to move on to investing topics before we lose the audience. We are going to talk about a Hirschy Indicator, probably not the one you're thinking of, especially with Valentine's Day approaching. Here's our standard disclaimer. No investment recommendation is intended. This is all about demonstration, illustration of a method that is over 8 decades in the making with the modern investment club movement. You'll hear opinions from us. Please do your own homework. We may own some stuff that we talk about. We'll let you know when we do. We do a monthly roundtable webcast. That is simply the sharing of 3 to 5 ideas amongst a group of friends that has a formidable record of performance over the last 13 years. Again, 13 years of monthly sessions. If you want to be on an email reminder list for that session, please send an email to nkabula1@comcast.net. And as always, if you want anything or if you have suggestions for future topics, please drop either one of us an email at those 2 email addresses shown at the bottom.
Yeah, Mark, I want to add that this month will be one of those rare months when we're going to be presenting on the 4th Tuesday of the month rather than the last Tuesday of the month. There are 5 Tuesdays in January, And the roundtable this month will be on January 24th. So those of you that are regular clients, please mark your calendars accordingly. January 24th, which is the fourth Tuesday. All the times will stay the same. Everything else will be the same. But we are not going to be on the last Tuesday. It'll be the fourth Tuesday, January 24th.
Good point. I'll try to remember to be there.
Okay.
All right, here's our graph we look at virtually every week. Again, just to characterize the longer-term stock market, the green bars are the value line arithmetic average. That would be as if you made an index and measured the stock price, collective stock price of the companies in the value line investment survey. So again, those are quarterly green bars going back to 1999, and they clearly show that the market moves in zigs and zags as it proceeds from point A to point B. The red dots are basically if you had taken and averaged the return forecast for all the companies in the book. Value line refers to it as their median appreciation projection. You will hear Mark Hulbert talk about VL map as is shown down there in the text box. And what we're literally doing there is looking at the return forecast, historical return forecast. The blue line is nothing more complicated than asking Excel to draw a mathematical regression through those green bars. And we basically live by the premise, or under the premise, that the green bars are going to approach the blue line at some point in time. And I just love Ben Carlson's quote, so it'll probably be there for at least a few weeks. Any comments, sir?
No, I'm busy answering questions right here, Mark, so I'm sure you've done a wonderful, wonderful job here, okay?
Okay. All right, well, let's generate some questions then. Here is our quarterly headache graph, but it's not a headache to me. I understand how this can be kind of a challenging graphic because of the 4-year lag, but let me tell you what it basically is first. It basically is the answer to the question, does what we do work? And the reason we say yes to that is what we're basically looking at here is quite simply a long-term range of forecasts. It's basically the same one as right here, but in this case, we're looking at the forecasts versus what actually happened. Basically, the green area, it's not expressed in dollars like the previous slide, it's expressed in percent. So we're comparing Value Line's forecast, as it says right here, what Value Line had projected 4 years previously versus what actually happened by the stuff in the green bar. So you can see the recession from 2008 and how ugly that got. You can actually see COVID over here in late 2019, early 2020, and the hole in the graph that made. But what we're basically looking at is what was forecast versus what actually happened. And the most recent result, which is really kind of fascinating, look at the uptick here for the 4-year period ending in December. The actual return was 12.2. 4 years earlier, back in December 2018, Value Line predicted 14.2%. So I would say that's fairly decent correlation. So again, with this, just again, close one eye and just look at it kind of big picture-esque. This is basically saying that forming these forecasts, much like we do with in our stock analysis or our stock studies, along with Value Line, it basically does work. It doesn't always work, but in general, I think there's a pretty good match between forecast and actual for this chart. So Ken, how many questions did I generate?
Well, I haven't even had the courage to press there yet, but I want to say that that having the experience of teaching math for about 35 years to students of all abilities and at all different kinds of levels, I know that there's about 35 to 45% of you that don't think in graphical terms. You don't think in numerical terms. Your minds don't work that way. And if the graphs are causing you some issue, we use a lot of graphs in what we're doing. Number one, because that's the way Mark's mind works and that's the way my mind works. But if you need further explanation about a graph, I've been holding the hands of 6 or 7 of our regulars for the last maybe 6 or 7 weeks, and I'd be glad to answer questions about any of the graphs that we use in the roundtable or in the bull sessions. All you need to do is make a screen capture of the graph you're talking about and then drop me an email. I'll either give you a call and we'll talk about it, or I'll write you a description back, an email back, or even on one occasion, I actually set up a one-on-one go-to-meeting and we talked about it. So I'm doing this because I enjoy teaching. It's my passion, and helping people understand numbers is something that I've gotten fairly good at over my lifetime, and I'd like to pass that on as much as I possibly can. So if a graph like this makes you want to run for the hills, first of all, take a few deep breaths, and then let's talk about it. Drop me a question or 2 or 7, and we'll try to explain what exactly this graph is saying in simple terms that people that don't think in numerical ways can maybe understand without any trouble. This is a powerful, powerful graph, and it's a beautiful picture of an indicator that is not really widely used by very many folks in the market. Is that a fair statement, Mark?
I think it's very fair, although I think any fans of Mark Hulbert and the newsletter he wrote for years, which rated investment newsletters, are quite familiar with it. And it's one of Mark Hulbert's favorite indicators, and he's actually featured manifest investing in the Wall Street Journal under this premise. So yeah, it's out there. All right, moving on. Headaches aside, the groundhog has given many of us a bit of a headache this year, but it's been actually a fairly decent year. You're not alone. There's probably one of the major things you can take away from this. And there are a number of investment clubs grouped all together there. Herb Lemkool does continue to hold down the individual champion lead over Lisa and Random Light and George Mackey. They're all definitely in the running. Perhaps we'll get a photo finish. The Dreaded Monkey is still in the top 10. That's a random dart tossing monkey that annoys us. And some fairly interesting stuff. Kathy Wood, by the way, has climbed out of last place. She was almost wire to wire. So we've got a few weeks to go. What I thought we might hone in on, Ken, anything else you want to bring out here?
Well, I just can't say enough for the fact that there's 4 clubs in the top 26, and there's 5 clubs in the top 40 right there. You have them in bold type, and it'll be interesting to see how far up this list they can actually travel. Space Coast, I think, was actually one of last year's co-winners, and looks like at the moment, at least, they have a slight lead on La Miz and Montgomery County and North Texas. So it's great to see these clubs performing like this. I hope that when you put together a portfolio, you're not just swinging for the bleachers when you pick your stocks. I hope you're trying to put together a portfolio that has some sense to it and has some potential to it going forward. Mark, I do have a question as to what those 2 arrows mean up near the top on the right-hand side. 2 big red arrows. Do they mean anything up there?
No, they're fugitive arrows. No, they're not. Yeah, and that actually leads us to the ones in italics are all what we refer to as celebrity participants. From David Einhorn, who's leading the contest, he's a one-time winner over the last 16 years, as shown by that asterisk. The asterisks are how many times an individual or a group has won in the past 16 years. You can see Warren Buffett, by virtue of Berkshire Hathaway, has a 2-time champion situation going on there. By the way, Herb has 2 clubs which have won up from the Traverse City area over the years, and they're just barely off this list. So he's doing pretty good all around. But what is really unusual about this year is the number of celebrities at the top. it's like really weird. We've never seen anything quite like it. It just points to the, I would say, the weirdness of the market. Highly technical phrase there, weirdness. And so what I did is I grabbed Einhorn and Eddy Elfenbein. We talked about a little bit. We'll show a little bit more on Eddy, and subjected them to this performance perspective page, because I want to make the point that Einhorn might be on his way to his second win all time. And you can see that this number is off the charts good. But when you look back at the previous 16 years, you actually get this for an annualized return. So when he's hot, he's very hot. When he's cold, he's very cold. And it's just something to take note of. In fact, we're going to talk about Josh Brown and the compound. They talk about Einhorn and how erratically performing he has been over the years. So when he gets hot, hit your wagon to that star. But boy, when he gets cold, on the opposite side of that type of characteristic is Eddy Elfenbein here. He's actually had the Crossing Wall Street. This is an exchange traded fund. This is the ticker symbol, CWS. Crossing Wall Street's the name of his site. And year in and year out, he's generating this type of number. So again, very consistent and just a completely different performance characteristic. And then just an FYI, our individual leader, Herb Lemkool, he's actually been in the groundhog like 13 or 14 of the last 15 years. And if you chart out his average results, he is on the all-time leaderboard, and his 15.4 obviously comes in pretty high on this ranking also. So again, that just gives you some context. Herb is also not erratic. He invests in soup when it makes sense to do so and that sort of thing. Here's a look at Eddy's.
Mark, I just want to add that just in case you want to clump Elfenbein's returns with the index funds that are below it on the list right there, I want to remind everybody about the slide we used last week that showed the difference between just a 2% increase in your return over long periods of time. That more than doubled your nest egg, just a basic 2% better. And if we say the market's done 10%, then I think Elfenbein should be credited with saying 2% to the market. And that is significant. It's nothing that we should be sneezing at. And it's not something that you would expect from a lot of the mutual funds that we look at, or the exchange traded funds.
In fact, I should disclose, I've been a shareholder of that particular fund since that date. So 2016, invested some money in it back when he actually came out with it. So have been a shareholder and watch what he does on a regular basis. And by the way, Tesla's just there to annoy us. These 5 stocks are the 5 most widely followed or held stocks by Manifest subscribers. And of course, that makes these numbers quite special. And Ken and I do expect all of you out there to buy us dinner when you see us. All right, here's Eddy.
And we should say, Mark, that Tesla return is a considerably shorter return than a lot of the rest of the ones on the chart.
Oh yeah, less than 10 years.
It goes from 2013 rather than from the 1980s or 90s. So, yeah.
Always account for the time frame when you're looking at a slide like that, and always look at the relative return versus the annualized absolute return. So here's Eddy, and how does he do it? Again, this is just a pitch for Eddy is a great source of medium-sized company ideas. You'll find a lot of growth rates between 7 and 12. That middle column that you see there. And his formula is basically find a great company at a good price, and he really is drawn to companies that are consistent. And his mother lode is in the earnings per share stability metric. He's obviously looking for really stable and predictable companies. So that's what he does. That's how he does it. And we basically tip our caps in his general direction and say thank you. He's also proven to be quite a resource for these type of companies if you're in an investment club. And I know, Ken, you probably have some of these in your clubs.
I would say, Mark, that if you're in a club and you can't go down this list and say to yourself, I'm familiar with half or more of the companies and I own 5 or 6 or 7 of them on the list. If you don't have that happening in the clubs that you're involved with, then I'm questioning if your club is sticking to the model, because Elfenbein has managed to come up with a list here that I would hazard a guess that 80% of them are in that up, straight, and parallel category that we covet when we're trying to buy for a club holding.
Yeah, there's a number of very familiar companies on here. FactSet Research has served us incredibly well over the years. Danaher might be worth a look right now. It's at the bottom of this list. This is $100 invested at the end of the year. So Danaher is actually down $5 from that point. So that could be an interesting study right now.
Well, I'm picking out Abbott Labs and Aflac and Heiko, Otis, Stryker, Middleby, Trex, all of those sitting in portfolios in clubs that I belong to. So there's, Fiserv I should add to that list as well, along with FactSet and Fair Isaac. So.
And I would also observe that Eddy seems to have that affliction that many of us do. I think he's emotionally attached to what he refers to as the duck stock. So we very painfully shed that, sold it from the round table, and hope to come back to it someday. But that is a stock which is resided in legions of club portfolios over the years.
I must admit, Mark, that I'm a personal holder of the duck stock. So
we all should be, I guess. All right, let's talk about the Hirschy Indicator, and not the Hershey candy bar indicator, the Yale Hirsch Indicator. Basically, Hirsch put out this, in fact, here's a look at it. First 5 days of the year, he actually talks about the January indicator. As how January goes is often quite telling with respect to the market. And this is what has actually happened over the last 5 days of trading. Thank God for Friday. That's this. This was Friday. And then Monday started extremely well, but finished pretty weak. So no matter how you measure it, those first 5 days have actually been pretty good. So here is Mr. Hirsch. And just an indicator which has actually proven to be one of the more reliable indicators of all. So no one knows. We've talked here in the last few weeks about how the year following a loss can quite often be double-digit results the following year. The problem is it could be double-digit negative too. Double-digit negative versus double-digit positive, although the frequency of double-digit positive has actually been a pretty good thing. Any comments, Ken?
Well, I like that these kind of interesting indicators appear to be pointing right now, sort of they're biased to the upside. Of course, we're looking backwards and trying to make rules about things that have already happened, and that's a lot easier than looking forwards and trying to make rules. So I hope that these come true. I hope that this Hirschy indicator makes it to the end and gives us a good solid, I'd be satisfied with a good solid 9, 10, 11, 12% for the year, Mark.
Me too. We'll be back with another Hirschy indicator as Valentine's gets closer.
Okay.
All right, this is just for fun. We'd like to pick a tweet out of nowhere and point it out. And this is just observing. I don't know if you've been to the grocery store lately, but eggs are the new Bitcoin. And the price that I paid for a dozen eggs, I had to do a triple take to make sure they must have thought I had 3 times as many eggs as I had in the shopping cart or something.
Are you investigating an ETF that covers just eggs, Mark? Is that what we're doing now?
We should. We probably should. And perhaps we can even get it denominated in Ethereum or something like that.
I have a person that lives on one of the roads about a mile from me that sells chicken eggs and duck eggs, and they have big colored paper signs over the top of their normal prices. The price on their eggs has gone up about double as well. So even the guys selling them out of their chicken coops in the backyard have raised their prices.
This could be a secondary market opportunity for you, sir. back up the truck. Maybe they've got them inefficiently priced, and you can. Well, you're already retired, well retired, so
Yes, I am. And I'm not giving that up.
you're not
So
selling eggs. All right, here's our busy chart of the week. This is actually from JC Parrott's at All Star Charts. We'll talk about a program that he appeared in recently, but it kind of jumped off the page at me when he was talking about it, because they were talking about how dominant, destructively dominant and distracting companies like Amazon, Apple, Facebook, you know the names, all the offenders, those technology, Google, all the technology stocks which have basically been uh, exerting extreme influence on the market cap weighted indices. And what he was pointing out is that, in fact, over the last several months, virtually all stocks are up. And what we're looking at here is equally weighted indices across all the sectors in the stock market. And what JC was pointing out is, first of all, this is all pretty strong for the last several months. You certainly can't tell that by listening to the news, because again, the S&P 500 and all of those type of indices are heavily weighted and biased by the Googles and Apples and Netflixes, etc. So, in fact, at the far right-hand side, they are all positive just recently. So kind of interesting. And I think he actually meant to put a bear right here in the title. Kind of a typo, but that this bear market has a fair amount of bull operating in clandestine fashion. Any thoughts, sir?
no, not at all, Mark. Let's move on.
Well, I know you've been listening to Josh Brown lately, so this is
Yes,
the
I have.
actual podcast. You can actually go to YouTube. You can either use that link at the bottom of the page or go to YouTube and search for The Compound. And this is the #1 session from last week. I did listen to the entire show. They are technical chartists, so you have to kind of deal with that a little bit. I would say the guy here, the second one in from the left, that's JC. JC is a modern day Ralph Acampora. I mean, he's just a joy to listen to. A lot of down to earth, and this is his cohort, Steve Straza. These guys basically come up with a bunch of different themes that are quite interesting. Don't let the title fool you. There's very little stuff about gold in here. He's a self-certified gold bug, but there's not a whole lot of content about gold. But they do go through and they talk about the importance of small, medium, and large companies and getting away from those ultra technology companies. And they have a part of this, a segment of the show where they show magazine covers, and it's just hilarious and almost chilling to watch. Of course, that's Josh, third from the left, and Michael Batnick. But I just found it to be such a comprehensive, good show, and that I would highly recommend. It's worth the entertainment. It's better than most of the financial entertainment that you find out there. What are your thoughts, Ken?
Well, Mark, I haven't even gone here yet. So I promise that in the next couple of weeks, I'll try to listen to it once or twice, and then I'll have a small opinion to share about what I think of it.
I think a lot of the stuff they talk about during this hour maps right over the top of some of the stuff that we have talked about for several months. And it's really kind of cool to see it, even if it's presented in some ways in a slightly tangential fashion. And I also love the way Josh Brown doesn't put up with any nonsense on the show.
Mark, what's the average length? Is this a half an hour, hour and a half? What is the average
These generally
length?
run about an hour. This one ran a little bit long. In fact,
Okay.
it's kind of fun to watch Batnick squirming in his seat as it runs a little bit long.
Okay.
Good stuff. All right. Speaking of performance perspectives, here is an update on our chart. We try to share this at least once a year. And a year ago, the numbers were twice as big on the left. That's how difficult 2022 has been. Still pretty good comparison when you take a look at some of the demonstrations in our community with respect to the market averages. Here's the value line arithmetic average. Now keep in mind that historically, the value line arithmetic average has beat this one, which is the general stock market Wilshire 5000. So again, over the last 5 years now, we basically have this performance deficit, which is not normal. And what that is basically screaming to me is, and we've talked about this before, there's got to be opportunity in small and medium-sized companies. Because again, the value line arithmetic average being all of the above, there just has to be opportunities there. Now, the balance of these are our demonstrations. Here's our most widely followed companies, checking in at a premium. Tin Cup was way up here a year ago. Had a tough 2022 and has come back down to, we hope, for better performance in the future. The Round Table continues to check in quite strong. It peaked at about 21% for its long-term average early last year and has relaxed back a little bit. And even with the very humbling results of Groundhog 2022, when you actually average it in with the last 4 years, it's still among the leaders. So Ken, that's not a camel, and it's not a skunk on the right. That is an Argentinian groundhog. And that's offered in the spirit of don't cry for me.
I was getting my bearings on it. We're looking at the tail here up in the front, right? So it's pointing back on the slide, but it's turned around looking over its left shoulder. Am I right?
Yeah, he's admiring that Groundhog Nation result.
Okay, great. Terrific.
Even with the 22 pain, the 2022 pain is included in that chart. So
you need to contact your daughter now and get us a correct pronunciation for this animal, okay?
I can do that.
All right.
I can do that. And then the other thing that we like to follow, even though we had a tough year with the best small companies, again, for comparison purposes, and we do demonstrate by picking that best small company portfolio and occasionally talking about it here, that checks in at approximately 12%, so it's right in line with this one. So good fun. All right, Ken, last week you talked about how we might reinforce some of our long-held principles, and I always like to have fun with Robin Williams. We can't get him out often enough for me, and this is one of our themes from very early in the days of manifest investing. You can see the date back here, 2008. This cover story is still available on the webpage, but this was just an invitation to think a little bit differently. So have you watched the movie lately?
Oh, I've not lately, but I've seen this movie probably a dozen times. This movie was one of my son's favorite movies growing up, so I can remember driving the van and having it playing above my head as the TV showed it to the kids in the back of the van. I just listened to it. I didn't get to see it, but I got to listen to it quite a few times. This one and Kindergarten Cop, but that doesn't make too many points about investing.
I'm sure if we worked at it hard enough, if Cy Lynch can actually link a muskrat to a beauty pageant to investing, anything is possible. And that was actually done back in this time frame also, a muskrat pageant. But again, this notion of being willing to think differently, and this was kind of it's one of our favorite slides from the early years. And many of you already know the story. You know, which one looks better to you, door number 1 or door number 2? And of course, you know the answer if you've been around here at all. These are stock selection guides performed on the same day on the same company, as it says down in the text box. And the difference being the one on the right is actually taking a look. This is all rearview mirror here, right? And you can go and read the story at that article. And then this is one which basically incorporates a little bit of windshield for what's going on. The reason Ken brought this up is we just wanted to again, think about this in terms of what we're seeing in the housing market. And I think that's pretty much what you had in mind, Ken, right?
Absolutely. We're seeing this same kind of abrupt fall off in sales and in projected earnings in a lot of the housing stocks right now. In fact, we're seeing that fall off to such an extent that I think maybe the analysts on their annual ride of the pendulum to the left and to the right and back to the left again. I think maybe they've swung that pendulum way too far to the negative side. And I'm suggesting that in the next 3 or 4 or 5 months, as interest rates begin to stabilize at a lower rate, by the way, than they were even a month ago, as interest rates begin to stabilize and then maybe even move down for houses, I'm suggesting that people will get used to the new fact that they are going to pay 4 or 5 or 6% for interest for a house, and we'll refigure the psyche of the American home buyer, and maybe housing stocks will become very fashionable again. Right now, you can pick up an average house builder for a PE well into the single digits. A lot of them PE around 4, 5, 6. So I'm not going to forget about them. One of our clubs that I belong to is going to do a detailed study of the home building market, and we're going to start that study within the next month or 6 weeks. And that means that we might be at the point where we're ready to put some money to work before the average investor decides that it's going to be an investment that's going to make them filthy rich. I like these graphs. I like the fact, and Mark, this is an epiphany moment for me when you wrote this and you did point number 2 up there at the under the windshield, and you said and then continued to say that it doesn't matter what the analysts think, but we have to take into account what they think, because what they think moves the market, because there's so many of them compared to the individual investor, the person that goes and buys and puts together a portfolio by themselves. What they think doesn't really matter. If they think it's going down, then in all likelihood, that's where it's headed.
Yeah, so if they're mapping out dismal expectations, if you really do believe, and I think most of us here do believe, that stock prices do follow earnings, the stock price was predestined to follow this. And this was Pulte, by the way, back almost 20 years ago now. And it just matters. It just simply does. So we include forward-looking estimates in the work that we do, and those are constantly, on a daily basis, changing. So here's a peek, and one of the things I think we will do, Ken, is I did put together a chart of the top home builders by market cap. I would like to do a little deeper dive into the industry. Some of this is going to rhyme with the stuff, the content that Matt Spielman has contributed on the Manifest Forum. As we mentioned last week, Barron's was out with a positive outlook on Toll Brothers, and I think the situation here is, I think we should also look at it in terms of the types of home builders. These guys are a top luxury home builder versus somebody who might be building homes more towards the median price levels, that sort of thing. Does the interest rates affect them differently? That's kind of the thesis here, that Toll Brothers will generally be less affected by the interest rate question. And it's a really kind of an interesting thing. Many people are running scared of what is coming in the housing industry and what it means for some of these stocks. And, you know, as you look here, I think you can make quite a strong case for, this is all earnings down here. These are earnings. And back in 1919 and then into COVID, with this downside pressure on earnings, you got quite a downside move in stock price. I think we could see that again, because here are the expectations for Toll now. Now we'll put D.R. Horton on a similar slide next week. I think D.R. Horton is down here, Ken.
Yes, it is.
As far as earnings. So it's even more pronounced. You see this type of a sag. So, you know, will there be an opportunity for accumulation? So if you actually believe that the numbers out in here are going to return to levels like this, And similar to that going forward, you can be presented with quite a buying opportunity. So again, looking at
Oh,
those companies like Toll Brothers. And then the other thing I wanted to point out, and then I'll turn it back. We've talked an awful lot about companies like Green Brick Partners and their geographic emphasis. And a lot of the statistics that are bandied about are basically nationally based. And I really think that you also have to bring geography to the question in the analysis as you look at some of these companies.
our Wolves Investment Club, Mark, has become nationally based. We have members from Florida, from North and South Carolina, from Washington State, from California, and still a core from Michigan up here. We discussed D.R. Horton at our last meeting, and the Michigan folks were saying how some of the subdivisions that D.R. Horton had started have kind of stalled out at the moment. They're not adding houses to them or anything. And our two members from Washington, after we had a kind of a pessimistic view on home building at the moment, our two members from Washington chimed in and said, you know, out here they can't build them fast enough, and they're building in all types of weather, and they're building further and further away from the core city, but they just can't build housing fast enough to meet the need. And this is at what somebody from the Midwest might consider outrageous prices for 2,000 or 2,500 square foot homes. So you're absolutely right. This geography is telling us something. I found it fascinating that Goldman Sachs has D.R. Horton on its high conviction list for 2023. To me, that says that there's a lot of people thinking past the next 3 or 6 months, and they're thinking of 2023 as an entire year. And there might very well be a very different atmosphere as you move into the summer and then into the fall with some of these things that are going on. The demographics that we referred to when we were really high on home builders, first of all, you could have bought home builders when we first started talking about them and made a tidy sum. We exited our D.R. Horton with a gain of $17,000 in the Wolves Investment Club, and that was after we sat on it for probably longer than we should have sat on it for as we moved into this bear market. But I'm really convinced that the demographics are still in place. There are still there's not nearly enough supply of especially starter homes and first homes for folks. And we're in this huge group of folks that are more and more wanting to buy a home and are doing everything they can possibly think of to put together enough money to make it affordable for themselves, including considering perhaps a smaller home than they had originally considered, maybe moving from a 3,000 square foot home to a 2,000 square foot home to get a start with putting themselves into the market.
That sounds like a first world problem to me.
Yeah.
Yes. So again,
I'm just not unsold about the housing market yet. I just think it's an opportunity for a lot of investing, especially if you have a long-term time frame.
Yeah, and the fact that Goldman is still pumping up the price there, that I'd almost rather they come out with a zero conviction list, put it on the zero conviction list, and give me an opportunity to buy in. No, seriously, if things do persist and weaken for a company like D.R. Horton or Toll, I just want to bring to the attention of the audience, we're talking about a company that had a stock price in the low teens, as this stuff all unfolded, right? And as the problems persisted, but the company is not going anywhere. It's a very high quality company. From here to here, sometime in the next year, is a gain from like $10 a share to $80 a share. You're talking about an 8-fold increase, and it's not inconceivable to see that opportunity present itself on one of these home builders here over the next several months or perhaps quarters, perhaps even a year. But it's just something that you might want to be mindful of and pay attention to the opportunity to capture some of that if it were to materialize again. And if you have faith in these numbers out here at all, it's actually a fairly comfortable place to be. All right. I think we just have a couple more slides and we can wrap it up. This was a mutual fund. It's actually an exchange traded fund. It was recommended by one of our community members, very experienced person, as the answer to the question, where might I hide while we figure out what in the world's going on with the economy and the stock market here in the not too distant future. And again, we advocate buying stocks, but sometimes if you're looking for a place to park funds, this exchange traded fund, which is the JP Morgan Equity Premium Fund, the ticker is JEPI. The premise is this one is not going to hurt you. It's not going to be a tremendous to the upside type opportunity, but it is chock full of very high quality companies and projected to generate a fairly decent yield. They actually do bump that up with a little bit of option activity, so there's a little bit of dividend yield boost with this particular fund. But again, a fairly decent place to hide. And from top to bottom, you can see these are a number of community favorite companies, certainly a whole bunch of blue chips. And you see just from the general quality levels, what could be involved. So again, could be a place to hide, could be something to take a closer look at, can be a place to shop for some opportunities also. I guess the one that gets me, Ken, is Comcast continues to show up on these lists with numbers like
you're absolutely right. We're doing work right now trying to beef up our pounce lists in one of the clubs that I'm in, and we're coming up with just lists from a lot of different places right now, and Comcast just pops its head up on the most lists that I've ever seen before, with numbers that are almost unbelievable sometimes. So I was comparing, Mark, the prove column to the projected annual return column, and was quite pleased that with 4 or 5 exceptions, the prove column and the par column are really pretty tightly linked to each other. And that means that the par numbers are really probably pretty reliable for a lot of these stocks.
Some of them might be a smidge low. I mean, like Hirschy might actually have a slightly low PE. I don't think I have PEs on this chart, but
well, the same thing about ExxonMobil too, Mark, right?
Yeah, absolutely.
Yeah,
a little bit more potential return there also. Yeah, normally the par is going to be slightly above the prove in general.
Yep.
All right. Here's a reminder that we are up to 950, Ken. We do archive all of these sessions on YouTube, and you can get either the bull sessions or the round tables. Our best small company from Halloween is still available here, so you can watch Ken and I or listen to us eat some humble pie. But if you subscribe, we'll let you know whenever new content is added. We have a lot of fun with that, and we look forward to the day when we hit 1,000 subscribers. This is just a reminder that on the back burner, probably sometime within the month or 4 or 5 weeks, we will hold a book review session. And I'm thinking we do them both in tandem after hearing Matt's comments last week, Ken. Tillinghast's book, he's one of the legendary Fidelity mutual fund managers. And Annie Duke is a psychologist turned poker player. And Matt basically recommended that the two go very nicely together, and probably take a look at them that way. You had mentioned that you think the price on Joel's book has been climbing on secondhand books.
Well, I'm reading down there. I got this same screen on my Paperwhite that I read from, and the used number when I ordered my book was something around $3. I think I paid $3.40 or $3.70 for my copy. But I noticed on my Paperwhite that that number has gone up into the mid-teens now. So
Uh-oh.
we must be pushing it up towards its actual price of $14.95. You know, that number from Amazon kind of moves up and down depending on the demand for the used book. So we must have some people buying the book to push that price up.
So what you're telling me is I can factually say that our webcast moves markets.
Well,
Hey, it's a you know,
I think that might be really out there, but okay.
if it's a fact, it's a fact, right?
All
All right.
right.
All right, and here's our PG-13 slide for the day. I don't know if you watched it last night. I only watched a few minutes of it, but the Georgia Bulldogs absolutely demolished the TCU Horned Frogs last night for the college football national championship, and as dominating a performance I think I have seen. I think the final score was 68-7 or something like that. And
And this Buckeye only has to say, imagine what might have happened with a rematch of a team that Georgia lost to or that beat by only 1 point on a botched field goal. You know,
yep.
just imagine what that championship game might have looked like.
Yeah, we certainly would have heard a lot about a Buckeye participation than we've heard so far today. But we did find out what happens when you open a can of that stuff on the right. It definitely did some damage to the Horned Frogs.
Yeah.
All right. In the appendix, just our small companies continue clicking away. They are beating the market since Halloween. And Portillo's was up 8% in the last few days, Ken.
Great. I would like to see it up another 17.9%. You know?
These all seem to be behaving pretty well, and we are going to watch. We'll actually answer the question. I'll add some home builder stuff to next week's session. We're also going to take a look at the efficacy of this one because Ken has asked that question several times, and do we care about that? All right. And last but not least,
Mark, I do want to ask our audience if any of them has any information that's not currently on the web about Technoglass. I'd like to get the citation and read the materials. If you happen to have an analyst's opinion that's proprietary that you'd be willing to send or anything like that, there are some disturbing articles about Technoglass on the web right now. And I'd like to kind of gauge in my own mind, at least, whether or not these articles have any, are they 100% true? Are they 10% true? What's going on with them? They are being put out by somebody that's trying to be a short seller in the stock, and that usually is something that is a red flag when a short seller tells you really negative things about the stock. But I'd like any information you might have about Technoglass, I'd like to have and to read and to share with you folks, in fact, if I find anything important.
Yeah, and I'm glad you brought that up, Ken, because we did have somebody share some of that literature with us. And it really did take me back to our days as a community when BioReference Labs, I don't know if you remember BioReference Labs, Ken.
Yes. Yes, I certainly do.
It ultimately became OPCO, but for a period of several months, if not years, our community basically got together and looked at, some of the short seller reports and that sort of thing. I mean, one was complaining about a janitor tearing up a check or something that trivial. And this could be the real thing. Who knows? The company apparently has connections to some South American governments that could be uncomfortable, but
Mark, I have a question for you, Mark. How can a company be based in the Cayman Islands and not be trading on the New York Stock Exchange as an ADR rather than as just a simple stock?
Again, that's all part. I think I turned Len Douglas loose on that one. Yeah, they're actually headquartered in Venezuela, I think, and with offices in the Caymans. So this all, let's put it this way: all of that is vulnerable to really bad perceptions. That's all I can say at this point. I go back to the way that our community very diligently looked at the bioreference lab stuff. We ultimately figured out that it was a bunch of rhinos that were upset with the way that the company was taken public. This goes back over a decade. And
Mark, I'm getting a hand in the air. Maybe we got some information here.
okay,
Daryl, I can't unmute you, but you can unmute yourself and then you can speak. Go ahead, Daryl, you're unmuted.
good afternoon, Daryl. Oh, do we not have him, Ken?
Well, he's unmuted, but I'm not hearing anything, so I'm going to do a mute and maybe an inadvertent hand, okay?
Okay.
Um,
But again, I see it as an opportunity because, again, going back to what our community looked at and the return is actually quite a rewarding situation for those of us that stuck with the company when we understood the whole question and we understood the biases that were on the sides of the information that were being presented. So it's a very valid
Mark,
thing to get into.
we have George Mackey in the audience, and George, now that you say this, I knew this and I don't know where it went in my head, but George is reminding me that foreign companies can choose to be listed on the NYSE or NASDAQ with no ADR. They only need an ADR if they're listed on another foreign exchange. So if they list themselves on the Canadian Toronto Stock Exchange, for example, and then want to list on the NYSE, they would need to do it through the ADR process. ADR stands for an American Depository Receipt, and it's a way of us buying stocks through our own exchanges that are listed on foreign exchanges. But George is reminding us that if they are not listed on a foreign exchange, they can choose to be listed on the NYSE or the NASDAQ. I would assume they have to meet all the rules and regulations of those exchanges then in order to get the listing.
Yeah, it definitely triggers the domestic reporting requirements, and it's just something that has actually been on the downside for quite some time. Companies have been reluctant or less eager to list on the U.S. exchanges for quite some time now. Maybe that does turn around a little bit.
Okay, Daryl's hand has gone back up again, Mark, so I'm going to unmute him.
Okay.
And Daryl, go ahead. Well, we're having sound problems, Daryl, because if you're speaking, we can't hear you. I'm going to go back to a mute, and then I have another hand from Len Douglas. Len, you're self-muted, Len. You'll have to unmute.
I believe I am.
Yep, go on.
Good afternoon,
Okay.
Len.
I just looked them up on Simply Wall Street. It says they are, I can't pronounce Avendia Circula. Well,
Yeah, it's in Spanish.
Circula Colombia.
Colombia, that's right.
Yeah, with their main offices, I think, in the Caymans. I think they're incorporated in the Caymans, if I'm not mistaken, Len.
Okay, but that's what they come up with as the, they're showing me a street address.
Right, and then these articles tie them back to some kind of nasty characters in Colombia that they tie them back to some, and I don't want to repeat these things because I don't know if they're rumors or if they have any truth to them, but you can read them by looking at news about Technoglass, TGLS. You can read them for yourself and evaluate for yourself. I'd like to find another source to see if there's any corroborating evidence for what this one source is giving us.
Now, Simply Wall Street is not flagging anything other than significant insider selling over the past 3 months.
No, that's
Okay,
worth digging into and putting in
thanks,
context too.
Yep.
All right.
Okay, Mark, I'm kind of caught up again here.
All right. So with that, let's go ahead and I will put DR Horton and the home builders in the queue, and we'll press forward with that. Keep digging on Technoglass. Len has dug deeper than humanly possible into the Texas Pacific opportunity.
Okay, and then folks, just a reminder again that the roundtable this month will be on the 24th, the fourth Tuesday. It will not be on the last Tuesday of the month. So adjust your calendars. And I think that the notice has gone out, or it will be going out momentarily. So if you haven't already received the notice, you should be getting it within the next day or so. Thanks a lot,
Thanks,
everybody.
everybody. Ken, I'm going to stick around for a minute if you want to.
Okay.
All right. I'll go ahead and shut us down.